It's a lot easier said than done. So I'm going to explain that to you today in 3 simple, fast steps. Step number 1, what drives stocks? First and foremost, that is earnings. Usually that's measured with earnings per share, but be very careful that you are factoring in inflation and the number of shares outstanding. To understand this a little bit better, let's go straight to the charts. First, we have a chart of the S&P 500, the yearly percentage change. And this is using dollars per share. So let's start after the GFC, or when the stock market started to recover. Going to 2011, it goes up to 10% earnings per share gain, and then hovers right around 5%. We had an earnings recession in 2015, and then we go right back up to a positive 10% in 2018. And then now we're again right around 5% earnings growth per share. But these earnings per share are in nominal terms, just like nominal GDP. So like the GDP, we would need a deflator of inflation. So even if we use the CPI, we've got to deduct about 2% per year. But everyone watching this channel knows that inflation is a lot higher than 2%. Let's just say that it's actually 10% using shadow stats as a gauge. Well, if our highest earnings per year were 10%, that would mean since 2010, we have not had positive earnings growth if inflation was measured the same way that it was in the 1970s. But the takeaway from this chart are the percentages have got to be lower when you adjust for inflation. And if you adjust for the correct inflation rate, they should be a lot lower. Next is a chart of the total shares outstanding for the S&P 500. If you turn on CNBC, you'll always hear how corporate earnings per share are going up. Well, that may be true, but the corporate shares outstanding are going down dramatically. And if there are fewer shares, then the earnings per share can increase without the actual earnings increasing at all. I also want to point out that just like companies can buy their own shares back to increase the earnings per share artificially, they could also sell those shares and more back into the market, which would decrease the earnings per share without the earnings themselves changing at all. But the key component is not necessarily understanding the earnings as they are right now, but understanding future earnings. Because at the end of the day, you're not buying a piece of paper, a stock certificate. You are actually buying the future earnings of that company. Second main driver is interest rates. There's 2 main categories here. First is the weighted average cost of capital, which is just a ridiculously over-complex way of saying, are you paying more or less for that capital than how much revenue that capital will actually produce? Next is consumer demand. So obviously when interest rates go down, you're going to make more money on that capital, and technically you're going to have more consumer demand for your products. This should increase earnings. If interest rates go up, then that means there's a higher cost of capital. You'll make less money on that, and technically consumer demand will go down, which both play into less earnings. So interest rates play a crucial role in today's earnings, but also in future earnings. The third key is the multiple or price to earnings ratio. This has 2 main components: the future earnings, which have a lot to do with interest rates, and the DCF or discounted cash flows. Those have everything to do with interest rates. The way the discounted cash flow works, let's say we've got a 1-year time frame and you have $1,000 to invest, and the government says, okay, we will pay you a 10% interest rate on that $1,000. So at the end of the year, we will give you $1,100 back. That's a pretty darn good deal. So XYZ Corp has $2,000 in earnings, but you are making 10% on your money. That is a fantastic return. So the price that you would be willing to pay for those earnings would be very, very low, called a 5 times multiple. But if you were only making 2% on your money, that's not very good. So you'd be willing to pay a much higher price for XYZ's $2,000 in earnings. Call it a 20 times multiple. This takes us to the chart on the board that starts at 1880, goes all the way to 2020. This is the Shiller PE ratio, or CAPE ratio. The multiple goes from 0 up to 40. 1880, right around 20 at a 5% interest rate. Early 1920s, it really dips down to its all-time low. Interest rates, by the way, were 7.2%. Then it shoots straight up that big bubble we had in 1929. Then it comes crashing down to where we were at the end of World War II. I want to point out interest rates back then were right around 2% because they had that yield curve artificially pegged. We kind of go up and down, then come to 1980, where the interest rates were 14%, but the multiple was very low. And then we go right up to the biggest stock market bubble we have ever had, where the CAPE ratio was over 40, but interest rates were still at 5%. The GFC comes crashing down. We go all the way back up to where we are today, where the CAPE ratio is right around 30, at the same level as it was in 1929. It's only been at this level 3 times in U.S. history. Going back to that interest rate, remember it was 2% and the multiple was very low. Here it's 2% and the multiple is extremely high. So your friend and family member Fred that always tells you that this multiple is justified because interest rates are so low, make sure you point that person right back to World War II, where the interest rates were the exact same, but the multiple was only 10 compared to 30. The main takeaway from this chart is that although interest rates are extremely important, they're not the only thing that matters when you look at the multiple. The biggest factor is the delta between future earnings and current interest rates. Step number 2, let's go over the impact of the multiple and interest rates on past performance of the stock market. And to do that, we're going to go to a blog post on my website, georgegammon.com. If you guys haven't gone there and subscribed to my email list, make sure you do that right away because I email you guys all the video uploads. And occasionally, I'll give you exclusive content for just those people on the email list. So you definitely want to do that ASAP. But this is a blog post called Actionable 100-Year Analysis of the S&P 500. What's the best strategy to maximize returns? First, I look at interest rates. And this is a chart of interest rates going back to 1790. It becomes obvious that rates are cyclical, and they usually go from 20 to 30 years. The first approach is I wanted to get a benchmark for the entire market, ranging back to 1871, which is the beginning of this calculator, going to December 31st of 2018. And this is a CAGR calculator, which is compound annual growth rate. And when you're looking at the returns of the stock market, or any investment for that matter, you never want to look at the average rate of return. That's how a lot of financial advisors pull the wool over your eyes. You always want to look at the compound annual growth rate. And I've got a fantastic video about that. I'll put a link in the description below. But from the year 1871 to 2018, when you adjust for inflation and include dividend payments, the compound annual growth rate for the S&P was 6.8%. So what would happen if you only invested in the periods of time when interest rates were in down cycles? The first time that happened on the chart was between 1871 and 1899. And keep in mind, I've got bull market here because there's a bull market in bonds, meaning the prices were going up because the interest rates were going down. So it'd be better if I had down cycle there. So replace bull market with down cycle and bear market with up cycle in rates. During that time, from 1871 to 1899, the compound annual growth rate of the market was 8.2%. Pretty darn good. From 1900 to 1920, the first down cycle in the chart, the CAGR was only 1.68. 1921 to 1950 goes back up. CAGR 8.63. Very good. And the next up cycle in rates, 1951 to 1980, 6.37. Didn't do too bad there. 1981 to 2018, we all know rates have been going down that entire time, almost 40 years. The CAGR for that time frame was 7.8%. As you can see, during interest rate downtrends, the S&P performed much better. But there wasn't that dramatic a difference, especially in the time frame between 1951, 1980 and 1981, 2018. So there's got to be something more to it, although interest rates do play a key role. And to emphasize that, I've got a quote here from Warren Buffett himself. The most important item over time in valuation is obviously interest rates. Buffett said last year, any investment is worth all the cash you're going to get out between now and Judgment Day, discounted back. And of course, when he means discounted back, he's talking about the discounted cash flow we talked about in step number 1. Next, I back-tested the Shiller-Cape ratio. The hypothesis here is that if you buy when the Cape ratio is low, you will outperform if you buy when the Cape ratio is high. Looking at my results, 1929, the Cape ratio is extremely high, right around where it is today at 30. If you would have invested $10,000 in 1929, over the next 10 years, your CAGR only would have been 0.81. So you'd only have $10,840. That is adjusted for inflation, though. But if you would have had that $10,000 invested for the next 60 years, your CAGR only would have been 5.89. In 1920, the Cape ratio was at an all-time low. If you would have invested that same $10,000 over the first 10 years, your CAGR would have been almost 13%. You would have had $33,000 for that $10,000 investment. But at each time frame, 20 years, 30 years, 40 years, 50 years, 60 years, you'll notice that the CAGR was substantially higher because you bought when the market was cheap instead of buying it when it was expensive. Next, I take it a step further because I realize most people aren't buying at a market high or a market absolute low. So what would happen if you would have purchased the Cape ratio every time it got under 10 and sold every time it got over 20? You would have made your first purchase in 1916 and you would have held till 1928. That would have given you a compound annual growth rate at 10. And I won't go over all the numbers, but it's obvious that your CAGR goes through the roof when you buy under 10 and sell when it's over 20. In other words, you buy when things are cheap and you sell them when they are expensive. But to compare apples to apples, I plugged that same time frame into the calculator to see what we would have if we would have just left our money in the market from 1916 all the way to 2018. And although our CAGR would have been low, we would have had $7 million, a lot more than the $3 million we would have had by going in and out of the market.
But here's where it gets interesting. Instead of just keeping the money in cash when you weren't in the market during this example, what if you would have just taken that money and put it into 6-month T-bills while you're waiting? If you would have done that at the end of 2018, using this same time frame, just to reiterate, from 1916 to 2018, instead of having $7 million, you would have had $17 million. So the best strategy by far was to buy low, sell high, and when you're in cash, keep it in 6-month treasuries. But the catch is I'm not saying you should do that. Why?
Step number 3, past results don't matter. And to show you what I'm talking about, we go right back to the chart we had in step number 1, the CAPE ratio. I've layered over a chart of the S&P 500 adjusted for inflation. And you've heard from every one of your friends and every financial advisor you've ever talked to that always invest in the stock market because over time, it always goes up. Well, first thing I'd like to point out is that from 1929 to 1980, the stock market did not go up. And if my memory serves me right, that was a pretty long time. Call it 50 years. So what would have happened to anyone who would have taken that advice in this time frame, call it from 1925 all the way to 1929, if they would have retired 20 or 30 years later, they would have had a lot less money than they started with. So if the past performance of the stock market doesn't necessarily tell us what the future performance is going to be, maybe we can use something else from the past, such as interest rates. And although that does help us to a degree, it doesn't tell us the entire story. As an example, the stock market went up from this point all the way to this point, but interest rates would have had to gone up during that same time. Very counterintuitive. And you can say, well, maybe interest rates played a role taking us from 1981 all the way up to 2000 in the massive bubble. And I'd agree, they would have played a role, but still at the top of our highest stock market bubble of all time, with the exception of today, of course, interest rates were at 5%. Well, that was nowhere near a historic low. As an example, back in 1880, interest rates were also 5%, but the multiple was only 20 compared to a multiple of over 40 in 2000. Future earnings plays a big role here as well. And when I say future earnings, I'm talking about expectations. We can safely assume that in 1929, expectations for earnings was very positive. Also in 2000, just like it is today. Well, we can look back at history and know that those future expectations for earnings did not pan out. And it isn't just the United States where past results don't really matter for future performance. Let's pull up a chart of the Japan stock market. From 1950 all the way to 1990, the stock market in Japan almost went straight up. That was 40 years. So imagine all of your friend and family member Freds in Japan and all the financial advisors like Dave Ramsey. What would they be telling you? The exact same thing they're telling you today. In the 1960s in Japan, 70s, 80s, they'd be telling you that the stock market over time always goes up. Therefore, whenever it dips, you've got to buy. Stock markets are very similar to a roulette wheel. If you spin that wheel 6 times and you get red 4 of the 6 times, it doesn't necessarily mean that there's any greater likelihood of you getting black on the next spin. Because each time that you spin that wheel, it's completely independent of past results. exact same thing in the stock market. So the only thing that you can do is take a specific time frame. So today, that would be February 2020. Completely ignore the past and look at the data. Look at the variables that you have at your disposal today. Look at the future earnings expectations, interest rates, and the multiples, and then determine from those data what may happen in the future. And that's why I say you can't make money long term in the stock market unless you understand that. Unless, of course, you get lucky, but I would prefer not to leave my financial future up to the spin of a roulette wheel. For more content like this that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this content right here, and I will see you on the next video.